from your perspective, what is your thoughts on using life insurance as an asset? You call it an investment. I almost see it as a storehouse to be able to invest in other areas that you've talked about in this book.
So there's a lot of reasons for life insurance. I don't think there's just one reason. You know, a lot of people like me, I will probably never use my life insurance policy for a loan. I probably won't.
Yep. Okay.
I don't need to. Okay. But I'll tell you what some of the great tax benefits are, of course, is first of all, it's public policy is what allows life insurance all the tax benefits. It's that, look, we're trying to take care of widows and children. That's really where it comes from. And it's good public policy. It's not unusual in different countries, although I think we're a little more aggressive with it than most countries. And, but you have, of course, two types of policies. One is a term policy. One is a permanent policy. I'll call it permanent. There's whole life, et cetera, but it's a permanent. And the way I explain the difference is one's an expense and one's an asset. And that's really, somebody once explained to me, in fact, somebody I know, I'm sure you know, Patrick Donahoe.
Yeah.
One day he was telling me, he goes, I said, what percentage of term policies are collected? He says less than 1%. What percentage of whole life policies are collected? He says over 97%. I'm going, okay, so here's what you're going to say from now on, Patrick. Term is an expense and whole life is an asset, because that's the case. Now, if you just want to have an expense, then term is fine for you. But what I think there's some really good uses for whole life. One is, of course, is you've got that cash surrender value, and if you need that loan, you can always get that loan. Okay. Another is, of course, is that it means that if you want to take care of people when you die, that means that you have an asset and you can spend all your other assets, and you don't have to worry about leaving your assets and living less of a life, so that your assets can take care of them. You can let the life insurance take care of them. And I think that's a huge one. From a tax standpoint, there's no deduction to buy life insurance. However, yes, there's no income when you receive, the beneficiary gets the life insurance. There's no income. Certainly when you borrow it, buy, borrow, die, there's no income. On top of that, though, if you use this collateral, because again, you're not borrowing from the policy. You're using the policy as collateral for the loan from the insurance company. That's a very big difference. And then people know what the reason this is important for people is if you, let's say, borrow from your Roth IRA, the interest you pay your Roth IRA is not deductible because it's not taxable. So that's a non-deductible interest expense. With life insurance, though, you're not borrowing from your policy. You're borrowing from the insurance company with the life insurance as collateral. That means that if you use that money for, say, real estate or for a business, the interest is deductible as real estate interest or business interest. And so while the interest income, see, this is what I love. The interest income is tax-free because the policy is still growing. And the interest income on that policy, if you hold it until you die, is tax-free. But the interest expense is tax deductible. So you actually get some tax leverage here by borrowing by borrowing that money. And you don't lose anything, but it's a debt like anybody else, and you are not paying yourself. You are paying the insurance company.
That's right. And a lot of people mix that up. They make it almost sound too good to be true. And it's two separate. It's like your cash value and your death benefit are growing pretty much regardless. The fact that you utilize your policy, you want to make sure that activity makes sense as well. It's not just all in one bucket. For sure. You are, there is a debate, and it's interesting because it's like a lot of things in tax. It's not super black and white, but you're saying even there's some people that say you have to have a third party lender to have it be tax deductible, but you're saying not. If you can prove that it's business purposes and you're working with the insurance company, you can write off that interest.
No. So here's the rule. And I tell you, I was in the national office of Ernst & Winnie back before it was Ernst & Young,
Hmm.
when the interest deduction rules came out. And we actually testified before Treasury on these interest deduction rules.
Okay.
And I got really, so I have firsthand knowledge of how these interest deductions rules work. It's a tracing principle. So you actually, any loan outside of your home mortgage, the deductibility of that interest depends on what the money was used for.
Got it.
Okay. So in this case, the reason you don't need a third-party lender is because you're not borrowing from your policy. You're borrowing from the insurance company. And the insurance company is a third party.
Yeah.
You're not borrowing from yourself like you are with a Roth IRA or a Roth 401k, Roth 401k. You're borrowing from the insurance company, a third party. So I don't think there's any question it's deductible.
And I think there's just so much misunderstanding as it relates to that because most people don't even use language well. And so of course, people might get it mixed up to say it's just like your Roth IRA, but you're totally right. There's a third party there. So yeah,
it's not at all like your Roth.
No. And I again, appreciate you writing this in the book and even just your understanding around it, because as you know, that sometimes life insurance gets a bad rap, rightfully so, by the way. There's I don't endorse, neither do you, all the things that happen when people talk about life insurance, but it can be a great asset.
Well, and I got to tell you, I think the most creative people on earth, besides lawyers, are life insurance people, because they keep coming up with new ways to sell life insurance. And it just cracks me up. I'm going, oh my heavens, some of these things that they're saying work, they don't work. Okay. And so just because life insurance doesn't mean it works.
Yeah.
So
I agree.
You do have to make sure, particularly some of these more extravagant things. A big term right now is PPLI, right? Private placement life insurance. There are situations where that works, but there are a lot of situations that are being proposed by aggressive life insurance agents that do not work. In fact, the IRS is going after them because of that.
Same thing with people borrowing money to pay life insurance. It can work based on your situation, but all the people that were pitched these sexy illustrations, and now with interest rates going up, it's it becomes very problematic. Tom Wheelwright, CPA for Robert Kiyosaki, author of Tax-Free Wealth.
And I'll never forget, Robert looked at me and he goes, "Really?" I said, "Yeah." He goes, "Whoa. The government's greatest power is the power to tax. The reason the dollar has value is because you pay your taxes in it."
Interesting.
If you were not required to pay your taxes in dollars, it would lose all its value. Now, let's get to the worst of it.
From your perspective, what is your thoughts on using life insurance as an asset?
It's fascinating when you write a book and you discover things you didn't know. And what I discovered was business is the #1 tax incentivized investment in every country. So the government literally will pay you to start a business. If you wonder, why did Elon Musk not pay tax for 20 years? Or why did Amazon not pay tax for 20 years? It's because of this.